This is Trepp Wire Week in Review for week ending March 4th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Joe McBride, head of CRE Finance, and Lonnie Henry, head of advisory services. This week, the third vaccine shot authorized for COVID is already being administered, and new estimates are that by May, adults who want the vaccine can get it. And the Senate has taken the first step in passing the $1.9 trillion COVID relief bill. In economic data, new orders for U.S.-made goods surged and manufacturing expanded last month. Initial jobless claims came in better than expected, but still higher than last reported. And a busy retail earnings week put up some solid wins. Despite some signs that we're turning the corner here, investors were concerned about prospects of stimulus and vaccine-fueled growth and inflation. Sounds like we've talked about this before.
Yeah, I mean, how concerning could it possibly be if we're just going to pump $1.9 trillion into the economy? We should be fine. I think the biggest news this week, for me anyway, is this third vaccine, Johnson & Johnson, and the fact that in the spirit of we're all in this together, Merck and Johnson & Johnson are, helping each other out, basically, to get this vaccine distributed and produced and distributed. So I heard this was the young people vaccine, where it's only 60 or 65% effective against infection, but it's like almost 100% effective against hospitalization and death. Maybe this is the call to arms for millennials to go out and get that vaccine and go back to Kohl's and Target and Costco and all these places that have already started to recover, right? Costco had a great earnings report. I think it was today. They say sales were up 15%. Kohl's also had a good one, and Target as well. I think we may have mentioned last week that Kohl's, which I have to say, we had a story last week about a mall in CMBX, and I told the whole story, and I failed to mention that Kohl's was the #1 tenant. And that's, as a tribute to Manus, I think that was a real miss on my part. So we're getting a lot of Kohl's talk in today. But one of the things that they mentioned was that their sales had increased $230 million just from customers who came in to return their Amazon orders. So what I think, this kind of generally proves the point that we've talked about many times, which is that a lot of these brick and mortar retailers are actually right where last mile distribution centers need to be. So, I'm just thinking of it now, but at some point, when does Amazon buy one of these firms, Target or Kohl's or something like that?
Well, they already bought Whole Foods, right? So a few years ago, they entered into the grocery market with a Whole Foods purchase. And, I think people thought Kohl's and Amazon teaming up for a return exchange relationship was kind of odd at first, but I think Kohl's definitely, won the argument there to say they got 2 million new customers in 2020 thanks to having an Amazon return center. And then they did some other incentives. If you brought packages back, they maybe give you additional Kohl's Casts or other things to shop at their store. So they really monetized that new audience that were coming in. So it'll be very interesting to see if they can maintain that momentum, or does Target or some of these other stores start to implement the same strategy and maybe water that down a little bit?
Yeah, I think it's important to mention this because we're always talking about, the death of the mall and death of retail and stuff like that. And retail that have tenants that are performing fairly well is not a terrible place to be. Probably not as good as industrial or somewhere else, but if you have a Dick's Sporting Goods and a Kohl's or a Target and something like that, you're probably in a Stop and Shop, you're probably feeling pretty good. But if you've got the JCPenney, Nordstrom, et cetera, then you're feeling pretty bad. I think that's, something that is really kind of valuable in doing this type of market research, right? It's like you really have to be nuanced in analyzing these different properties. On a totally separate note, I just want to mention that as part of this kind of macroeconomic section of the pod, we had that kind of interest rate scare last week, which sent big tech names and big growth names kind of cratering on Thursday. And then on Friday, it was all better, right? So, I think that this market in general, we're always looking for a narrative to tell about the market. And last week, the narrative was interest rates are going up. But, I think that there's the bigger issues are where big funds are flowing on any day-to-day basis. And I think that 1.5% 10-year treasury yield mark kind of spooked flows. And then I saw an article today, just on the headline right before we got on, that the average 30-year mortgage rate just went back over 3%. God forbid, right? Like, can you believe, like, we're living in a time that we're fretting over a 10-year treasury that's like going over 1% and a 30-year mortgage that's going over 3%? Imagine if you told your grandfather that when he was paying a 16% mortgage.
Well, imagine what happens to residential home values overnight if interest rates were just to go back to historical norm, about 5 or 6%. All that equity would evaporate very quickly. So it's interesting to see how people, revisionist history. We're looking at things in a two-week window now, not looking at how things were over the last few years.
I promise is the last thing I'll say about it. It's painkillers for the market. It's steroids for the market, right? It's whatever analogy you want to use, where like once you start, if you stop, you're going to have problems, right? So I don't know how they ever allow rates to go back up significantly, unless it's literally a huge swath of buyers and owners of treasuries that just dump treasuries onto the market. And then, at some point, inflation, even in the gauges that are, pretending that there isn't inflation, at some point we're going to start to see it. But anyway, we can move on to the stuff we actually know about.
So Trepp released its delinquency report, and we saw the largest improvement since the beginning of the pandemic, which, by the way, it's almost a year now. We're about a week from a full year that we've all been working from home.
Haley was saying this yesterday. It was March 9th was the week that we got the email saying stay home, and we'll be back in 2 weeks or a month.
Right.
I think everybody got a similar email back then thinking this was going to pass, and look at us now. I've been sitting in this chair for almost a full year, got about 15 pounds more pushing down on the chair's
your
bottom.
BMI's up, your blood pressure's higher, your mental health waning.
What's not higher though is the delinquency rate. After the huge jumps that we saw in May of June in 2020, where we got to just over 10% delinquency and just a scotch below the all-time high, which was back in 2012. We've been improving ever since, and February's rate came in at 6.8%, which is down 78 basis points from January. So looking across the property types, or the major property types, nothing too surprising. I think, one of the nice drops that we see here is in lodging. So in hotels, which has obviously been very, very hard hit, it went from a little over 19% to 16.4% month over month. So, whether that's some delinquent and defaulted loans falling out of the pool, through dispositions and sales out of foreclosure and stuff like that, there's probably a little bit of that. And there's also the element of cures, right? So places in Florida, Phoenix, Texas, even maybe the Jersey Shore, God willing, some of these places are starting to get people really coming back. I mean, Miami has been on fire for a long time, so I shouldn't really single them out. But multifamily, flat, office, flat, both at kind of just over 2%, and retail was down about 80 basis points. So kind of nice improvements in the two sectors that were hit the hardest. A couple more numbers and then I'll relent. Still 24% of all hotel loans are in special servicing, and that was down just, a couple of basis points month over month. And 16.7% of retail loans are with the special servicer, also just down a few basis points.
Yeah, I'm maybe not as excited with this news, Joe, just because, as we talked about last week, there's a little more nuance to it, right? So seeing top line reductions and delinquency doesn't necessarily mean that these loans are back in service without some sort of forbearance or help through FF&E reserves and so forth. So I think it'll be interesting to keep our eye on multifamily as we move forward. I saw an article, I think it was last week, where property owners were actually bringing suit against these eviction moratoriums and starting to get some rulings in their favor. And so it'll be very interesting if that, makes its way up to the Supreme Court at some point, and those are, considered unconstitutional, what actually happens to the performance on multifamily. I think we've kind of been masked at this point to actually see the true impact from COVID because of the forbearance programs and the eviction moratorium. So I would say if I was looking at things to keep an eye on, I would probably be focusing a little bit on multifamily. But I would agree it's good to see lodging and retail, finally coming down a little bit from their all-time highs or near all-time highs.
Yeah, just one other note here that speaking of kind of, did you use the word masked? That's
don't do it.
It's really going into your, COVID is really seeping into our vocabularies here. Yeah, the percentage of loans in the grace period, which we talked a lot about early on in the life of the podcast, loans that have missed a payment but are not technically 30 days delinquent. Usually it takes kind of one missed payment, a month to pass by, and then another month kind of to even enter delinquency. That number's at 2.3% in February. Back in March, April, May of 2020, that number had kind of skyrocketed. So 2.3% is still higher than kind of what you're used to seeing on that number, but it's much closer to kind of historical averages of, loans where the check didn't arrive on time type of thing.
So looking at some of the stories we've seen this week and tracking through Trepwire in some cases, we saw a number of changes around office, one particular in Midtown.
Yeah, so a couple stories in Trepwire this week, and this is kind of cool thing. I got to give Manus a shout again. I'm sure everyone's missing him. We'll hopefully have him back next week. This is where, you connect news stories that are otherwise just very commercial real estate related, and you connect them on tenants, you connect them on properties, you connect them to the CMBS universe, which is why it's important to bondholders, right? So when big tenants move in or out of a property, that will affect the value of the underlying collateral that serves to provide cash flow to the bondholders. So this one was Equitable Life Insurance is moving out of its Manhattan offices, or I should say relocating its Manhattan offices. They've signed on for 130,000 square feet at 1345 Avenue of the Americas. Interestingly, that's a property that is in a 2005 deal, FB 2005-1. It's got to represent a very high proportion of that particular deal because most loans are 10-year loans, and this one happens to be a 20-year. For that office, the going was good already, and now it's getting even better. They posted a DSCR of 2.5x for the first 9 months of 2020 with occupancy at 93%. On the other side of the coin, this company, Equitable Life, is moving out of 1290 Avenue of the Americas. So they're really just moving up the street. And that property backs a single asset deal, Vornado 2012 6th Ave. I love when CMBS deals have like actual words in them to explain, what's actually there. So this one's VNDO 2012 6 AVE. That's a 2.1 million square foot office also in Midtown West, a couple of blocks away. Equitable will be vacating that entire space. And it's interesting, the second largest tenant in the servicer data is listed as AXA Equitable. And that's actually as of securitization, it was the first largest tenant with 423,000 square feet. So if that's the same Equitable, which I think it is, that's a big downsizing of space, right? So they're basically cutting their space almost by 75%. So that's kind of just a little nugget there of if and when we get back to the office, and we'll talk about it a little bit later, but it's going to make a lot of sense for a lot of companies to downsize, I think.
And so we saw a related story. JP Morgan is subletting some of its space in Manhattan.
Yeah, it's funny. This one's not Midtown, though. It's JP Morgan's looking to sublet just under 700,000 square feet at 4 New York Plaza in the financial district. Also 100,000 square feet at 5 Manhattan West, which is Hudson Yards, which is interesting because I'm not even sure if they had fully moved in there or not. They may have. I'm just kind of guessing there because obviously, BlackRock and a lot of law firms from Midtown and other big companies had plans to move to Hudson Yards if they hadn't already. For any of you folks who were Grand Central Midtown commuters, you saw over the years JP Morgan taking down that entire building. I think it was on 47th Street, between 47th and 48th, between Park and Mad. They were taking down this huge building to rebuild it, which I thought was a feat of engineering. I wonder if, how the plans are going on that one. So anyway, a couple of things here to mention. Jamie Dimon in an interview mentioned that, and this is actually the opposite of what David Solomon from Goldman said last week, right? So, and maybe that's just goes to show you the slightly different cultures of the banks. But Jamie Dimon was basically saying that the shift to remote work may lead to permanent changes in how businesses operate. And the quote was, New York could have a little bit of a difficult time. Already real estate needs will come down. Most of us are going to need more open seating because you don't need 100 seats, 100 employees. You're going to need like 60. So, he might have gotten a call from his commercial real estate guys after that saying, what the heck, man?
Well, it's funny. You put 700,000 or 800,000 square foot on the sublease market, and then you tell everybody that, oh, by the way, you don't need this much square foot to operate your business, but please come sublease our space. So it's a little contradictory there. And I think it's funny. We talked a little bit last week, Joe, about Boeing up in Washington trying to sell their corporate campus. And it's almost like these guys think they're going to a restaurant and ordering off a menu. It's like, well, I think we'll sell our corporate campus today, or we'll sublease our 800,000 square foot. The market has to have an appetite for that. And so I think it'll be very interesting to see, supply and demand, at what point do those things meet and at what price? And so when these things actually start to come off the market, what are those lease terms look like? And how does that force a major reset in the market for everyone else that hasn't made that decision, but still has to deal with the outcome?
So furthering this topic, Green Street came out with a little research report, which said that they expect, basically they said, if companies go to a 1 day per week from home concept or a 4-day work week, which I hope we don't, even though a 3-day weekend sounds good, but it just feels like not a good thing for our souls, that it could reduce office demand by 15%. So I know this is like a super high level number and, nobody really knows, but at least they're putting a flag on the ground somewhere.
Yeah, I think they've tried to quantify it, but I think at this point it's too early for any of us to know what the new normal looks like. I think with the vaccine news, we've seen an uptick in retail we talked about earlier. Who's to say that the next shoe doesn't drop with office and people start going back to the office and feeling comfortable? I think it's just like anything else. If you get 4 or 5 firms, turns into 10 firms, turns into 100 firms, a lot of this chatter goes away when people just start operating as usual.
And there's still a lot of uncertainty here. There was a survey put out by a company called Morning Consult, where over half of current remote workers said they would feel comfortable returning to their office if the employer beckoned them to come back. And yet, at the same time, 65% would not return to the office unless all of their coworkers have been vaccinated. So it seems people are a little conflicted.
Well, this reminds me of like my conversation with my wife every day about what's for dinner, or like, what are we going to do on Saturday? Where it's like, well, would you eat this? And I'd say, yeah. And she said, well, would you eat this other thing? And I say, well, yeah. And then she says, well, which one do you want? And I say, well, whatever you want. This is the concept of, well, yeah, I guess I would come back if my boss told me to. You know what I mean? So, and then I don't think a lot of bosses want to tell anybody to at this point. So I don't know, it's going to take some sort of liability, disclaimer of liabilities, or, some sort of act of Congress, which says you can't sue for an employer asking you to work and you get COVID. Like we're entering into a really weird time where a lot of people are probably going to be happy to go to the restaurant or the bar, but they're going to claim or they're going to plead COVID when their boss tells them to come back to the office. Or maybe I'm just cynical about the human race a little bit right now.
Yeah, you are.
It's okay, Joe. I'm on the same page as you. I would read this as people are excited about the idea of going back to the office, but I think after 2 or 3 months, they're going to be like, working from home wasn't so bad either. And so, like they miss what they don't have or they want what they don't have. But as soon as they have it and there's expectations and deadlines and we want you to be here 5 days a week, I think some of that allure, the commute, everything else makes that probably a little less desirable, especially given people have proven to be productive from home. So I would agree with Martha. I think people are just a little bit conflicted on this.
Yeah. So that other part you mentioned, which is the first part is 50% would say, okay, if their boss told them to, but then on the other hand, 65% say they'll only come back if everybody's vaccinated, right? Which again is even more kind of weird, crazy HIPAA privacy, I don't know, like type of deal where can you really ask somebody if they've been vaccinated if you're an employer? I don't know.
You get a card. And we want to round out our office news with an update. We talked about WeWork's termination in the DC area, and there's new news there.
Yeah, so another connection to CMBS here. We wrote about it in the Wire. $32.8 million loan called the Manhattan, which is not in the Manhattan, it's in the DC. It's backed by a almost 78,000 square foot office in Washington, DC. WeWork is listed as the top tenant at 42% of the space on a lease, at least according to the servicer data that goes to 2031. So WeWork is essentially has given its notice of termination on that lease, and the loan is now with the special servicer. They're trying to figure out what to do with it. For the first 9 months of 2020, the loan was at 2.16 DSCR, which is a high good coverage ratio, and occupancy was 96%, but that could quickly fall to 55% if WeWork was to go dark or leave. This loan does back about 4% of a 2017 deal, Credit Suisse C-Sale deal, 2017 CX9. That deal is part of CMBX 11.
I know, Joe, before WeWork and the whole debacle that was their IPO or that didn't happen, there was a lot of discussion around underwriting for WeWork deals because they did have really long-term leases. It was almost a too good to be true. And a lot of people in the market would say it's proven to be too good to be true. Although I would say related to that, I think Adam Newman won some settlement or came to another settlement where he gets an additional $55 million in payout in some form or fashion. So for him, he's doing okay.
It's just always amazes me, this guy can build a company and do all this kind of financial wizardry and take on long-term liabilities and generate revenue from very short-term income streams. And it can all kind of go down the chute a little bit. And he could still stand around and say, give me another 100 million, please. I actually saw that guy walking in Midtown once. He was surprisingly tall. I'll give him that.
And we have an update on Washington Prime Group. We talked about it, I believe, last week.
Yeah. So, we mentioned last week that they had missed an unsecured debt payment, but that they still had 30 days of grace period. There's grace period again. We're talking before it's considered a default. Looks like they're preparing for a potential bankruptcy, Chapter 11. So I think we have a loans in the spotlight list on Washington Prime, which you guys, if you're clients, you can check out to see which which malls they own. It's not the same, but it brings back memories of GGP back in the day when the entity itself went bankrupt. But at least in the GGP case, there were still some malls that were operating fairly well. So you kind of have to pick through the different assets here to decide which ones are going to come out of this okay and which ones may be in real trouble.
I always think it's funny on these deals, Joe, when they hire really high-powered attorneys and negotiators, and they say things like preparing to potentially file. It's kind of like when the general manager of your favorite sports team says that they are not shopping the best player on your team for trade. It just makes you a little bit nervous, and you know what's probably going to happen. And I think this is probably in that same vein. They skipped the payment. They're trying to play hardball. But at the end of the day, it doesn't look good for Washington Prime probably in this instance.
Is that a Deshaun Watson comment right there for the Texans?
Well, you know, and I'm a Dallas Mavericks fan, so there's been some rumors about Kristaps Porzingis being on the trading block, and I'm hoping they don't let him go. He's not our best player. Luka's our best player, but we do need Kristaps.
And before the pandemic, CRE CLOs were surging and represented one of the fastest growing sectors of the commercial real estate finance space. We released our CRE CLO report this week that took a deeper look at this sector. Our own Catherine Liu reported on that. What were some of the key takeaways, Joe?
Yeah, so, before I get into the report itself, just as a reminder, I'm sure most people listening probably have some sense of what this is, but, in the securitized market, this CRE CLO concept is really, it's kind of an old vehicle structured in a slightly new way that's been used very well since around 2012. And this is a way for bridge lenders to essentially tap the capital markets in a different way than how they normally do, right? So a company like Ladder Capital or Annaly or Blackstone or TPG, KKR, whoever, they make their bones or they make their money by lending in the floating rate, shorter term duration market. A decent amount of the loans are on what would be considered transitional properties. So properties that either have low occupancy because they lost a big tenant, or they're older properties that need rehab, or whatever the case may be. It's a value add opportunity. So these are usually 2-year loans with 2 or 3 1-year extension options, floating rate based on LIBOR. And what these, a lot of times they're mortgage REITs, what they'll do is package up a bunch of these loans that they've originated and sell them off through this CLO structure. Now, the difference is that the issuers of these deals, or I should say the originators of the loans, will usually hold on to the bottom tranche, or what they call the preferred equity piece of these deals. And what that does is it keeps their skin in the game. But anyway, that's kind of my Manus educational segment there. So it was a huge growth area in the securitized market pre-pandemic. I think it had kind of doubled in 2019 in terms of issuance volume. But then, of course, in 2020, we had a big drop. So in 2019, it was about 20 billion that was issued, whereas in 2020, we had only 8.7 billion. The cool thing is that the pipeline right now for CRE CLOs is very, very strong. The pipeline for the first quarter of 2021 is already at about 4 billion, which is essentially half of what we had last year. So doing really well there. A lot of demand for, shorter term floating rate paper, especially in a time when people are worried about interest rates rising. And interestingly, these loans and these deals are not included in our delinquency rate calculations. That delinquency report includes a pool of loans in CMBS deals that we deem to be, let's say, vanilla, right? So conduit, single asset, single borrower, and large loan deals. We get rid of all the weird stuff, cell phone tower securitizations and small loan, non-performing loan deals and all that type of stuff. And CRE CLOs is one of the assets that we remove from the equation when we're doing that stuff. So back to the track here, the total delinquency rate on this particular universe is 2.63%, which is kind of, I guess, a half of the other delinquency rate we mentioned before. That's up from only 11 basis points a year ago, pre-pandemic. And a big part of this is the fact that the issuers themselves don't want to lose access to this CLO capital market. So if there are problems, if there are problems with the loans, very often the issuer themselves or the originator will buy the loan back out of the deal and work on it themselves, as opposed to leaving it in there to be worked on by a special servicer or something like that. So that does give a lot of comfort to the investors who can see that, these are some pretty large entities that are, backing their own, what is it called? Eating their own cooking type of thing. So, and the last thing here is that actually in CRE Direct, we had a story today. It was one of the CRE Direct staff reports, which said that Ladder Capital has lined up nearly 300 million in fixed and floating rate loans kind of on the tarmac right now. And they had only started accepting applications a couple of weeks ago. So they had kind of like, a lot of these REITs during 2020 had kind of gone insulated a little bit and had to work through some things and obviously slowed down on the origination side. And now they're all starting to really hit the ground running. And to see that they could get 300 million on the, in the pipeline in just a couple of weeks is really a powerful statement about where this market will go. And I have spoken too much.
That might be a record for you.
Yeah, thanks for channeling your inner Manus on that one, Joe. We got really deep in the weeds on that. I think with the market and the current status that it's in, there's probably a pretty heavy reliance or need for that type of bridge financing. It had taken off in 2019, as you mentioned, about $20 billion in issuance. I think at the CREC conference back in 2020, when we could still go to conferences, they were, the chatter was around issuance maybe being around 25 billion, and it ended up being around 8.7. So, I think it's interesting when you look at these numbers in hindsight, because I remember in the frothiness of 2019 and the first part of 2020, almost every deal that came to market was marketed as a value add. And so there was some component of a story loan on every deal, it seemed like. Even though cap rates going in on these things were 4%, everyone was saying there's value add and upside. They've had 10 years of rent growth and you're buying stabilized assets at a 3.5 cap, but it's a value add. And so it's kind of reset. But I think with that hard reset of last year at 8.7, there's definitely going to be a need for this type of financing in the market today.
Well, just look at Acor last week, right? That we talked about. Acor raised this giant fund to provide bridge financing, and they may be doing more weird stuff like mezz debt and preferred equity and stuff like that. But there's definitely there are a lot of assets in need of a lifeline to get through the next 6 months or the next year or so. So,
especially when there's like perceived equity still in the assets, right? So the market overall hasn't seen major declines. We talked a little bit about some of the appraisal reductions, but on the grand scale, it's been fairly trivial in terms of the number of properties that's been impacted negatively to that level. So yeah, I think you're going to see a lot of these guys trying to come in that mid-tier mezzanine bridge lending space and really try to help some of these properties stay and get some of that upside on the rebound.
Yeah. So just another note on that. I mean, it's not really CRE CLO related, but it is related to kind of new lending opportunities and how that pipeline is opening up and increasing. So we're actually doing kind of a pilot program with a partner of ours called Mountain Seed. And for clients of our Trepp loan product, and this is a shameless plug, but I actually think it's worth it because it's some pretty cool stuff. For clients of our Trepp loan product, they're actually going to have access to exclusive lending opportunities, both lending, new mortgage origination, and also distressed loan sales. So that's coming out Friday night on our platform. There's only going to be kind of a handful of opportunities up there at first. But once we start to kind of get the interest and get people clicking and get people connected with these opportunities, we're going to probably really start ramping that up. So, something that our client base is always looking for is ways to deploy capital, and we're adding some really interesting options that are kind of very much A to B, where you can kind of pick up the phone and make a call and see if the deal works for you. So if you are a client out there and you have any other questions, you could reach out to us at podcast@trepp.com about that.
So those of you that have been paying attention to the news, Texas has been in the news in recent weeks for lots of reasons, snowstorms and other things. And Lonnie, our man on the ground in Texas, is going to walk us through what the latest story is coming from Texas these days.
Yeah, so I used to be super proud to be from Texas, and with our electrical grid mismanagement of a few weeks ago and our governor's announcement a few days ago. I don't know how I feel about that anymore, but we're definitely opening back up for business. So for those that don't know, our governor, Greg Abbott, made an announcement this week from Lubbock, Texas, that Texas was going to be fully reopening for business, and he was eliminating a mask mandate effective March 10th. So effectively, all businesses could be open at 100% capacity, indoor dining, outdoor dining, bars, etc. No holdbacks. And so I think from the economic perspective, there's definitely some upside and some maybe good idea kickstarting the economy or getting it back up and running, but remains to be seen what the negative outcomes will be in terms of just packing people back into restaurants and bars. I would say the Dallas Stars and the Dallas Mavericks, who are in season right now, have come out and said at their sporting venues they're still going to adhere to the pre-announcement seating limitations, and so it'll be interesting to see. Part of the mandate that was removed basically allows private businesses to still implement their own procedures. So we'll see if that takes shape. But I think, what it goes to speak to is that we had a piece written this week by one of our research associates, Max, highlighted or focused on some of the Houston market and some of the distress that's been seen there. So there's no denying that the impacts of COVID shutting down, offices and retail and so forth, like there's been a real impact to the marketplace. And so, you can see distress in the hotel and office sectors. In our tool, we actually have a trends and rankings dashboard where you can go in and rank properties by delinquency or debt service or trailing 12-month occupancy. And if you look at office or you look at hotel, Houston is in the top 5 and has been pretty much since March. And so it's a major hub in the U.S. economy. It has a port, international airport, but the distress has been pretty widespread. And so we highlight a couple of buildings in the piece. And so 2 Westlake Park, located in the energy corridor in Houston, was backed by an $87 million loan. Saw a large drop in occupancy due to natural gas company ConocoPhillips vacating 200,000 square feet in response to the hardships of the last oil crisis in Houston. The occupancy had dropped all the way below 6% in 2019 and was sold out in December for less than the most recent valuation. So that's just one of many examples in the Houston market that we could talk through to show the hardship. So hopefully, if there's some silver lining from the governor's announcement, it's that maybe some of the commerce, some of the office, some of the stuff here in Texas can rebound a little bit.
In the vein of silver lining, hotel occupancy went up because people had to vacate their cold homes in the winter storm. So I think for the first time since the pandemic, they had occupancy above 50%.
Yeah, what was really interesting about that, Martha, is a lot of folks lost power at their home, so they went to a hotel only for the hotel to have a water main bust or the power to go out, and then they had to leave the hotel and find someplace else. So it is good to see that, at least at some level, the hotel occupancy went up, but even that was, I think, fairly short-lived with some of the other challenges we faced from the snowstorm. So fallout hasn't stopped from that. I saw last night the CEO of the ERCOT grid here in Texas was actually given a notice of termination. And so the fallout from the blackouts and the power outages are still being felt here.
So let's look at spreads on new deals, Joe.
Yeah, so we had we had a listener request many months ago that said we should talk about new issue pricing in the CMBS market every now and then. So I can't remember who it was, but if you want to remind us, send us an email at podcast@trepp.com and we'll send you a t-shirt. So there's 1 or 2 interesting nuggets here. There have only been a couple of conduit deals that have priced since the new year. There were 2 in January, 1 in February, and there's 1 coming out soon. But the first couple in January actually saw spreads on the AAA last cash flow senior bond come in almost around 20 basis points. And actually, when we first saw this, we kind of had a double take to say, like, we got to make sure these numbers are right. And that's in relation to spreads earlier, or I should say later in 2020, which were more in the kind of 80, 75, 85, 84 area. And then we said, well, no duh, interest rates have gone up by like 40 or 50 basis points. So what happens is the base rate or the base swap rate upon which the spread is added, if that base rate or swap rate increases, but the all-in yield required by the buyers of the bonds remains the same, then the spread decreases, right? So it's yield minus spread equals rate. And if that rate increases, the interesting thing, and actually Manus and I both kind of said this, is that you would have thought that the AAA guys would have at least gotten a little bit more juice out of these deals, given the recent rise in rates, but they didn't. On the other side, though, in the BBB minus, which is the lowest investment grade tranche, those have remained fairly consistent even after rates have risen. So last couple deals are in the 300 to 330 basis point range on top of swaps, I should say. So we saw a similar tightening on the BBB minus side as well. And it was, it's a much bigger tightening here. We're at 300, 330, 325 around basis points on the BBB minus, the lowest investment grade tranche. And that compares to the deals done in late 2020, which were in the 400, 430 range. So I don't think all of that is due to rising interest rates. I think some of that is due to the fact that, the bond investors have a little bit more of an optimistic outlook, and they continue to get insurance premiums and pension contributions and 401k contributions to all these funds that need to allocate capital. So, there's still a decent bid for new issue CMBS.
And our shout outs of the week, we have several I'm going to walk through. Steel City Dave and Joe D both actually called out our own Haley Keene. They gave her kudos for her moderating debut last week on the pod. So nicely done. And Joe D, who Manus calls the Yankee Clipper, if I'm not mistaken, he loved the REIT interview with John Worth, and it was released earlier this week. It was good overview of the REIT market. Jeffrey W reached out, and Calvin Y commented on our blog, suggesting that he wants to see more predictions. So I'm going to have to get you and Manus and Lonnie to offer a little bit more of your clairvoyance on what's coming.
Oh yeah, I'm happy to blow smoke and talk completely with no consequences to my predictions, as long as you're not graded to any of them.
As long as you're not graded. And Jeff M had some questions about special servicing and receivership.
Yeah, Jeff had some pretty pointed questions about hotels and special servicers and how and why special servicers are acting the way they are. I think hard to answer the question. I don't want to get too much into it. I think every deal or every loan and every situation and every borrower and special servicer is a different story. So I can't really comment kind of overall. But I know, Lonnie, you looked at some numbers in terms of how much is in the pipeline versus how much has gotten resolved.
Yeah, there's been a pretty small number, about less than 200, say, hotels across the U.S. since January of 2020 that have been sold off at a loss. So Texas leads the pack, has 43 properties. Georgia has 30. North Carolina has 21. But there's nothing really that stands out here saying, any one geographic region or any one property type has been completely outside the realm of norm, considering where we're at. If you look at the total volume of properties transferred to special servicing relative to what's been sold off, I think it's still a pretty small percentage.
Yeah, so there's still the story is still to be written on these, right? And how the special servicers and borrowers interact, I think is going to be, it also depends on your point of view, right? So there's people who will rail against special servicers because they had one bad experience or they've heard about a bad experience. And then there's others who will say, especially now that it's a different world in dealing with special servicers now than it was back in the day in the crisis times. But at the same time, remember, these guys got a couple thousand loans thrown at them like in the span of 2 months.
Joe, the lodging hotel sector can recover if the vaccine rolls out with Johnson & Johnson and we hit a critical mass there by May and occupancy shoot up to 90% because there's this pent up demand. it behooves the servicer at this point to kind of hold out hope for that recovery, because it could happen very quickly once the faucet's turned on.
And we saw inbound from Tasha B. Our own Tom Fink shared our REIT episode on LinkedIn, and Nate, who also was the guest on the pod, shared our guest episode. Dan McNamara, whom we've had on the podcast, he shared last week's episode. He said it was great, loved the co-tenancy, which Professor Lonnie walked us through, and the new appraisals on regional malls, hotels, and office space. And we've seen in the news this week discussion about reappraisals on malls.
Yeah, we talked about it last week in terms of the average drop in values for retail versus lodging versus other property types. I think retail was in the 45% area. I think some articles that came out this past week were showing even higher numbers in the 60% range. I think that may be due to the fact that they kind of culled their list down to specifically to malls, whereas what we were talking about was all retail. But I'm glad to see that our friends are following our lead.
And after a year of working from home and demand for mostly leisure wear, aka elastic pants, clothing retailers are seeing new interest in going out type apparel. This could be a sign, guys.
Can you remind me what going out apparel actually is?
Well, it's a waistband, like not a stretchy one.
Is it the jeans that are actually sweats, but they look like jeans, the jeggings?
I didn't know you had a pair of jeggings. That's frightening.
Oh, I'm just going to pretend like I've left my suits. They're still in the dry cleaning plastic in the closet. I'm going to pretend like they're going to fit when I'm fit for duty and going back to the office or going back into the real world, because I'm too afraid to actually try them on. They probably don't fit. So at this point, I don't know. There's really no difference for me. Like I just have, I have one attire. It's like blue jeans and an Under Armour golf t-shirt. So if that qualifies for going out, then I guess that's good. If not, I'm definitely behind the times, because that's all I've been wearing.
Under Armour free plug. You're welcome.
Well, I've got about 30 pairs of shoes under my desk in the office, and I haven't seen them in a year. So hopefully I'll see them soon. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.